Welcome back to F.A.C.E, Mystery Trader 99.
Right there, can you hear me?
Yep.
Oh, we've solved the mystery.
Perfect. And then do you start video?
No, no. Well,
Yeah,
if you
we can
want to
see
see
your
your
screen.
face, if you want to,
No, no. Can you see my screen?
yeah, possible
Ah,
catalysts.
okay, okay,
You're
cool.
prepared. You have a whole PowerPoint here, buddy. I appreciate all the preparation you go through every time you're here, and looking forward to an update on your global Forex parity
I appreciate it, Dale. Thank you
programs.
so much for having me again. I'm glad to be back with you. It's been quite a crazy couple months we've had.
Well, you know what? I want to acknowledge on your last interview. I think you were talking about 2,200 gold by next spring. Almost got there in a hurry.
Yeah, it was
Great
the
call,
original.
man.
The original call was 2,100 by the end of 2021, but my
Yeah.
secret number was. I'll go and give you my exact number here, target in a
Oh,
second.
of course it would be a secret. But anyway, it was a good call. You weren't bearish. You
Thank
were
you.
looking for higher numbers. Nice call.
I appreciate it, and I'll kind of go through for those of you who weren't on part. I didn't watch 1 through 3, and we'll put the links in the description. But basically, we'll go over what happened, what we talked about in part 3, some of the things we discussed, some things that did happen, some things that did not, and then we'll kind of move on to some of the Forex updates. We'll kind of go over bonds for a bit, gold, and then kind of tie everything in together at the end. But thanks again, Dale, for having me on. It's been quite an eventful few months. It's amazing how fast these markets are moving these days. But initially, when we were on last time, we discussed how, almost perfectly, you always invite me on at the perfect time when big moves are about to happen. Literally, as we were just discussing that morning, the move to my initial target of 1142 on the euro dollar happened, and then from there, kind of a second impulse up to my upper blue trend line on the macro charts. So that happened. Great British Pound would show relative weakness towards the euro. The dollar would then consolidate down to its lower 10-year trend line support. The Fed would obviously, pump stimulus. At that time, the dollar index was around 99. Obviously, it's come off a lot since then. In just 2 months.
Yes.
It's crazy to believe.
Yes.
So that came off down to my 10-year trend line. Fed would be pumping a lot of money and stimulus into the system, which would put further downward pressure on the U.S. dollar. Treasury yields would have one more drop before a final bottom would occur. The Treasury yields would remain depressed. And also that gold would hit 2,100 before the end of 2021. That was obviously conservative. Now we hit 2,089. So I was off by $11. I don't know if you want to give me that $11 or not, but we're almost there. And then I kind of discussed last time how Treasury demand would actually start overflowing into gold. And now we're starting to see a lot of that over the past 2 months kind of creep into the system, how gold was relatively cheap on a historical basis. And then also based on gold DXY pairs and gold TLT ratios, we can kind of see, how is gold on a relative basis as far as valuation going back, an extended period of time. And eventually my final target for this bull was 2237, but I'll kind of get into why I say that number. The only things that didn't happen was the DXY consolidation would take 37 months. Turns out, remember in part 1 and part 2, I thought it was actually going to be a faster cycle. Then back in May, it didn't seem like it was going to be able to catch up in time. It looked like it was going to stall out, but sure enough, it actually is faster than the original 37-month target that I said last time. So it actually ended up going down to its key trend line further. Or further and faster than initially expected. And then the Great British Pound would fail the orange trendline support, which it has not done yet. It actually ended up holding that for now. So as of right now, the pound is not signaling we're going to parity just yet.
Okay.
But I kind of wanted to go over kind of a general, where are we now? Obviously, the last 2 months, a lot has changed. I mean, there's still 40 million plus without jobs. Many of them are being structurally moved into structural unemployment because they're being, out of the labor market for longer than a 6-month period. We have federal stimulus that obviously softened the initial blow from COVID and all the other shutdowns. But, many of these policies were kind of kicking the can down the road. And so as of right now, a lot of people are not necessarily feeling the pain, but some of these, unemployment insurance, which was $600, is being dropped now to $400. And evictions have been deferred, so that's kind of putting off any kind of REIT Armageddon in the real estate sector. So there's obviously a lot of potential still catalysts that could cause more downside, but as of right now, we're kind of weathering through the storm. And that's kind of where we are as far as a global economy. And then obviously continued stimulus is putting additional pressure on currencies as governments try to act and support their economies. So initially we'll get started. We'll go through some of the Forex updates of what's happened over the past 2 months. Here is the euro dollar chart that we've discussed many times before. Back last time when I was on, euro dollar was right around the kind of 108 level. It was holding this kind of key flat bottom Bollinger support that I said was kind of a brick wall of support. And I said that it would more than likely go up to the 50-day moving average, or if not exceed it. At that time, my blue line was actually off a little bit, so I readjusted it to actually connect to all the dots, all the previous peaks. And it comes out to about a 117 handle. It obviously overshot that a little bit, but then now it's obviously come and hit the 200 monthly moving average on the euro dollar, and so far it's rejected. As of right now, it's actually above that upper Bollinger, which is actually a very rare phenomenon. You only see that a few times over the past.
What's the implications of that?
So I'll show you them actually right now. So here's one in early 2018. It exceeded the upper Bollinger and then it pulled back. Here was another one in 17. So short term, typically it implies some sort of a consolidation. The last time it specifically rejected the 200 above the upper Bollinger, it then pulled back to the 50-day. So whether or not we're going to get that large of a move or not, remains to be seen. But the only other examples are all the way back here in 08. There's also another overshoot, and then it had a higher peak, and then it kind of started to consolidate.
So you use these a lot, Mystery. And, I remember seeing Bollinger talk about when the bands compress.
Correct.
That the first move out of these bands is a breakout fake out. And then the next time back within the bands is a real move. Have you noticed that too?
That is, in many ways, it's kind of like there's like elasticity with the bands. When you overshoot it, it wants to come pull back, and then either start the next leg, or oftentimes you can actually have some sort of the initial move might actually just be a head fake to the upside before.
That's what I mean.
Reversal downside shock. So it depends. A lot of it depends on the setup.
Okay.
The thing about the reason I've called this the global Forex parity thesis is technically right now it's still a hypothesis, because until this holds, we're literally, it's 15 months later since we first discussed it. That's how long it's taken us just to get back here to test it, to verify that this is in fact going to happen. So ironically enough, the theory is literally being put to the test over the next 30 days. 30 to 60 days. We'll know if this in fact is the move to parity or not. Now, if this completely, pulls back and it just blows out here all the way up to the 120s, then I'll be the first one to admit it's not going to happen.
Okay. But so we're at that important inflection point.
This is literally the most important inflection point in the past probably 5-10 years. I mean, it really is that important. Now, what happens here will depend largely on kind of what I'll break down in the next slides. But just know that we are at a very key important inflection point, and that this will determine whether or not the theory will either come true or be completely nullified. So thus far, I mean, the entire cycle has been pretty repetitive. I mean, it's been predictable. You kind of tell where it was going. Now the bigger question comes in, on the relative basis, where does Eurozone and the US kind of differ in their policies? This kind of gets into physical stimulus. I mean, we're really kind of getting into the weeds as far as macroeconomics and how it's going to impact the currencies based on how much money they're printing.
When you use major trend lines like this, Do you need more than one close above it to feel confident that the trend has broken?
Normally, I agree. I think in this specific case, because I'm actually lining up all the actual inter-month peaks,
Yeah.
not necessarily, but if you're
Okay.
using the bodies of the actual, the upper close of the candle, if that's what you're using as, then yes, overshoots can happen. But I like to use the absolute peaks, so it just kind of lines up better.
Okay.
Um, so, I mean, obviously down here is still the parity window. It's obviously still open. So the real question is, are we going to have some sort of setup like in 12 to 14 where, we have that touch, albeit it happens sooner than expected. And then are we going to have some sort of reversal here? And I'll kind of break down the mathematics of if we do, what are the exact dates we'll see some sort of confirmation.
Okay. Yeah, we're
Here,
right at that test. Okay.
yeah, here's the pound dollar. Initially, last time we were here, and I said if this magenta line held, then it would be a repeat of this pattern. Thus far, it has not broken that support, that key support around 120. Sorry, I apologize. And if you look here, the MACD is kind of confirming a similar kind of horizontal stalling pattern as it did here during this period where it did not break down, but it kept rejecting at the 50-day moving average. So, we rejected once here at the 50-day and then it fell off. 50 monthly moving average, and then here again. And every time I did it previously, it would pull back to the 13-day moving average almost without exception. There's 1, 2, 3, 4, 5 examples. And every single time the next candle hit the 13. Well, the 13 on this candle is down at 127.80. So, previously it was 5 for 5. Whether or not it will happen again, in theory, it can. This time in 2018, it did not, but I think just because the gap was so large. But so far, this 50 monthly moving average has been kind of a brick wall of resistance, and these patterns are kind of similarly forming. So you could deduce from this that as of right now, the pound is not ready to make the next move down. For now, it's still kind of in a consolidation holding pattern. Whether or not it will break out above the 50 or not, like it did here in 14, we'll find out here pretty soon. But if it holds here, then the next path should be back down towards kind of the base of this channel in the low 120s. And then on the other key premise of the thesis was that pound would have to relatively underperform euro in order to get to parity just because it's starting from a much higher base. Well, last time I came on in May, we were actually right here in this large red candle. It was in the middle of this monthly candle. And even though both euro and pound have increased relative to the dollar, pound is still underperforming euro.
Yes.
On a relative basis. And so
Yes.
this is still holding true. And right now we're literally resting on this orange key trend line. And if you look, if the MACD back in 07, we had a similar pattern where it kind of stalled up into, or kind of had a slow drift up into the center line, and then it formed a bearish reversal, and then it rolled over. Well, we just formed a bear cross here, so it is doing that. And now, in order to confirm, we would need the MACD to kind of roll over. If it does, that indicates that the pound is going to make a break lower. And if it does, then it will start a similar flushing pattern sitting here back in 07, 08, 09.
So in FX terms, you would favor long euro, short pound.
Yes, if you're between those two, absolutely. Or if you're, in a dollar, if dollar is your main currency, you could then perhaps be net short pound over euro. So it depends on how you want to trade it. But
Okay.
I think in theory, pound should be the more bearish bet of the two if you're having to choose. But I mean, obviously you can play both if you want. But that's how I would, if I had to put my, so to speak, bet on it, that's what I would bet. Is that, in my opinion, I think I'm actually short both right now, but I think pound will have a more room to fall, and oftentimes when it does, the flushes are usually harsher and harder and faster. So to me, that's the way I would go. But I mean, if you wanted euro, you can do that too. But this is more just to show on a relative basis. This one pair has to confirm to the downside in order for global parity to happen at the same time, because the currency is more valuable on a relative basis. So that's basically the whole point of this chart. And I know you like to do the inverse of this chart, but for me, in order to line up with
Okay.
my thesis, it's just more convenient this way.
Okay.
And so this is actually the kind of the bread and butter of the whole global parity thesis. Is that, you know, initially what we had expected was that, you know, when I was on last time, it's this tall red shooting star. That's crazy that it seems like forever ago, but it was just a few months ago. And I said that from there we were going to flush down to below the 50-day moving average. And I thought it was going to kind of stall out here just below the 50 and then trend sideways. Well, it turns out, and if that had happened, it would push off touching the purple base trend line until March 2021. That actually ended up being wrong. It actually ended up being significantly faster. And ironically enough, in theory, it may not seem like it now, but it's actually more bullish for the dollar that it happened sooner, because what it did is essentially pulled forward that consolidation, which is now forming at this, you know, at the key purple 10-year trend line. Now, you also notice here that it's exceeded the lower Bollinger significantly, and it's only done that on the DXY one other time, which is back here in 2018, and then it formed a solid base here.
Where would it get back inside the bowling band? Where is that last band that's touching the top of this little white candle that's beginning to form?
That's at about it's a let's see, 90.
94?
It's just, yeah, it's like 93.50. Sorry, 93.90 something. I mean, it's basically 94.
Okay.
So, and in this pattern,
So
it kind of
just like
stalls.
the euro, it's the inverse, good or bad.
Correct. Exactly. Yes. I mean, because the euro is 57.6% of the DXY,
Right.
naturally they're going to be highly inverse correlation. Now, what's interesting, and I'll kind of touch on this a little bit, is there's a bottoming pattern sequence that happens every time it kind of has reached the bottom, and I'll kind of break it down mathematically. I don't want to reveal it yet, but that kind of gives us a counting, kind of like a countdown clock as to if this is to play out. And remember, this purple trend line has to hold in order for the thesis to prove true. If this completely blows out and we flush to 88, then no. I mean, you can toss all this into the garbage can.
Okay.
So this really is putting both the theory and a lot of major macro forces to test right now. Obviously, you know, Fed printing $2 trillion, that's what accelerated this flush even faster than anticipated, which is because they're printing so much money. And obviously now, with President Trump signing the executive order, you know, they're, you know, flooding it even more into the system. So let's see. And then, so for now, the key takeaway is that this 37-month stalling pattern is not happening because price action here did not flush. It just held at the 50 kind of as a mean reversion and went sideways, whereas we went straight down to the purple trend line. So it has to hold here, but if it does, this should be a solid base for a very strong impulse upward over the next 2.5 months.
Okay.
And so we'll kind of break down. I wanted to go over bonds a little bit and kind of tie it into, you know, the currency as well. Last time when I was on was here in May, and I said there was going to be another drop in yields, but that we were getting extremely close to par value on U.S. Treasuries, which is $1,000 on the bond. So sure enough, we had another rollover, and you know, started to drift lower. But you know, this is kind of comparing the two different patterns. You're starting to realize we're basically running to the law of diminishing returns at this point. I mean, you're trying to squeeze blood out of a diamond because there's just not much room left till zero bound. So you know, if we start to see some kind of a consolidation here, you could see some sort of a double bottom, or if we do, it may just slightly lower. But I last time we discussed, you know, negative interest rates. I don't think we're going to go there. I don't think the Fed wants to go there. So if you believe
I think
that,
they're turning, Mystery. What do you think a 120 yield would do? Would that be part of the dollar rally? if yields rallied, I'm talking about 70 bips, 60
Oh, you're
bips
talking all
from
the way up
here.
to like up here up to
Yeah,
the yeah.
one 120.
Then once you start to see after any major yield flush, once you start to see yields kind of pop off bottom, what that's starting to signify is that inflation is now finally starting to creep back into the system. I mean, you're basically liquefied the system and you're pumping money. At that point, that would actually send a lot of different signals to both potential U.S. equities, gold, and other commodities as well. Um, it depends on why it's going to pop off zero. For now, we discussed last time, and you actually brought it up, which was a great point, that because the Fed is propping up bonds, treasury bonds, and buying them, what's it's artificially doing is suppressing, keeping the yields down. So because they're stepping in, I don't know if it can break above this kind of, 80 basis points level. I think it may kind of
Okay.
stop and hold here, and they're going to intentionally keep liquefying the system until they feel like bond pressures have subsided. I could be wrong. Maybe they'll let it pop. But for now, I think they don't want to send any kind of harsh signals to the market. So I think for now they're stepping in, but there's just only so much more you can squeeze this. I mean, we're already down at what 50, and
Yeah, half a
it kind
point.
of, and you can see it hit this flat lower Bollinger Bands, which I've always said is kind of like a brick wall of support, kind of like Euro did, a couple months ago. Anytime you see these kind of flat lower Bollingers, it's really hard to kind of push it any lower. I mean, you're really pushing against a brick wall. So this could potentially be a double bottom in yields, so just be aware of that. MACD is also supporting that. I think it's had enough. I mean, it's reached decade lows, and then now it's finally starting to try and build a base and rally back up. So we'll see. I mean, it's to be determined, or yet to be determined. But for
I
now,
think these are even more than decade lows. I think they're century lows.
well, the
I've heard a
actual
comment that rates have not been this low since the American Civil War.
on a real net basis, yes, you're correct. What I meant is the MACD is at is a
Oh,
decade low,
oh,
but
okay.
the actual yields is an all-time low. They've never. I
Yeah,
mean, as far as nominally twos, fives, tens, I mean, we've never been slow. So I mean, even going, I mean, in '08, we were nowhere near these levels.
right,
So this is,
right.
and I said last time, a lot of this is partly because the rest of the world, many of the sovereign debt is obviously negative yielding. So that artificially pushed our curve down even further on the long end, because basically everyone's just flushing into ours in order to get some sort of a yield. So that's also why this drop down here was so extreme. Is just basically everyone piled in. But right now, even with everyone continuing to pile in, there's really not much more room to go. We're kind of at that law of diminishing
Yeah,
returns
people
now.
were financing their log cabins at a 0.5% back then.
I know, basically, yeah. I mean,
And
if you can find
cannons.
if you can find one, yes, if you can find
Yeah.
one, you're refinancing. But
All right.
okay, and so then we're kind of go. So last time when I came on, at the time, gold was about 1720, 1730, the day I came on, and when I said 2100 by 2021, it sounded like a crazy call. It sounded extreme, but what I'm about to show you will show why it actually was not that extreme, and actually it's part of a much broader a macro bull market. So when I came on last time, we were still underneath this purple horizontal resistance line, kind of right around here.
Yeah.
And this actually, the upper blue line connects the 2011 peak all the way back to the 1970 peak. So this is a 40 plus year formation. And for those that want to see the full chart, I have it on Charts Coach. But oh, sorry. But naturally, I knew that this is there's basically a magnet up here pulling price action towards it. And once we get there, that's when we could see some sort of a potential consolidation. But in the meantime, even when we were here and here, everyone's saying gold's going to crash, gold's going to crash, gold's going to crash. I don't know what they were looking at, but everyone said it was going to crash, and I was like, I have not seen a more bullish chart, in a decade. So even the MACDs are starting to confirm, this is a full-on bull market similar to the one we had in '09 to 11, and that peaked at 150, and the MACD is still at 126 right now. So it's showing we still have a little bit more room to go. The RSI is also approaching decade high, multi-decade high levels. And right now, currently, in May, I was on Chart Coach. I was pounding the table telling my members, just buy shares. Don't worry. Don't listen to any negative. Like this is a major, massive macro bull. Plus, never has the fundamentals for gold been so strong because they're printing trillions of dollars, which is we've never done before. So when you're monetizing this much debt, real net interest rates are already negative, even though if they're not nominally, on a real basis they already are. So it's basically, you know, a rocket ship for precious metals.
Would the picture change for you if we started trading underneath 1800? Because I think we could pull back there, but I'm wondering if, you know, that if that's a
today
breakout.
it's already down $65 today alone. I don't know if you checked the
Yeah.
gold chart today, but it's down big today. And I had said in May, in June is going to be a consolidation month. July is going to rocket. And then August will be another consolidation month because we've just overshot the upper Bollinger on the monthly chart so much. I mean, we really shot out. So anytime you have this sort of, you know, price action needs to consolidate a little bit. And that's initially why I gave the 2021 instead of saying end of this year, because I knew there was going to be one last sort of, you know, consolidation to kind of cool off before you make that final bullish impulse. But this kind of shows you how when you kind of take a step back and look at the monthly charts and not look at the, you know, kind of the daily noise, it provides a lot of clarity as far as what the major formation we're in.
Love telescopes, bro.
Yeah, they're awesome. But this so it's obviously off the charts, so you can't just, you know, it'd be nice if you could just do it. But based on my calculations, I'm showing 2237 as a possible final peak. It may get all the way up to 2250, you know, give or take $10 or $20. I mean, at this point, it's splitting hairs. But that's my final target of where this blue trend line will go. Now, previously, I thought, you know, March 2021 was going to be where we touched down on the DXY, and that was going to give us a lot of time, more time in this bull. But now that it's potentially being moved forward, this may actually be an interim peak, similar to here, if this trend line chooses to hold. Now, the percentage move of the 70s gold bull and the 05 to 11 bull, those are between 650 and 750%. This one is actually only about 150%. So it's a much smaller move. I don't know if that means that blue line is going to get taken out, it's going to rocket higher, or in fact, because there's two prior peaks, now we actually have a trend line. And before in 11, there wasn't a trend line. It was basically, there was no basis to know where it would stop. But now that we have these two, you know, usually these macro multi-decade trend lines, they're pretty tough brick walls. I mean, so we'll find that here pretty soon. But that kind of does tie into if the DXY is going to bottom in my target window of between October 2nd and October 30th. That would make sense why we would, you know, kind of peak here, because then the dollar would, you know, start to rocket higher, and then I would obviously provide some sort of a headwind. Now, I don't think gold's going to crash per se because there's still a strong fundamental backdrop, but it will definitely face some headwinds, some downward pressure. But up until that point, I still see gold, you know, after this month is over and in September, October, it should have one last kind of hurrah in order to make it up there. And then kind of, I want to do also kind of like last time, kind of touched on how, you know, I believe that U.S. Treasury, the reason we were going to get to 2100 was that a lot of physical demand for treasuries would actually start to overflow or spill into the gold market. And sure enough, that actually started happening. And I showed this chart last time, which is the gold TLT ratio, which is a 20-year, 20-plus year Treasury ETF. And when I came on last time, we were actually at about 10.5, which is right here. Oh. And sure enough, we've actually broken out above the channel. And now it's above 12 to 1. But on a relative basis, when you look at, you know, where it was in 2011, it was all the way up at 22 to 1. So net, long term, if we're talking, 3-5 years, if you want to talk about the real macro bull on gold, I'm not just talking about this short move that we're experiencing now, but I mean, you're talking out a decade or two. This implies that there is still a lot of upside on gold.
This is just beginning.
Yeah, this is, and this channel has been so tight it's been almost in lockstep on a 1-to-1 ratio since 2015, and relative to bonds. Now, once treasuries hit their par value, that's by definition when this is going to start to really rocket higher, because as we said last time, once bonds hit that that ceiling, that invisible ceiling, then this ratio will really start to accelerate. And that's what you start to notice. Once we start hitting that lower bound on the 10-year, that's when this chart started to break out. And now notice, interestingly, the last time the DXY had a major bottom was Q1, Q2 of 2018, and it also broke out. So is it possible this is a false breakout? It's possible. But it also does coincide with that being a major kind of dollar bottom as well.
Interesting.
And then this is the other chart that we discussed. And last time when I was on, this is the gold DXY ratio. So this is actually against the entire US dollar basket, not just specifically the dollar, but the entire basket of currencies. And I said, I don't remember if last time I had that, that picture of the Milky Way galaxy and the solar system, and how everything was actually, all the currencies were actually rotating around gold, but gold itself was elevating its value across all currencies. And last time it came on was the purple arrow. We were at about 18-to-1, and just in 2 months alone, we've already rocketed up to 22-to-1. So this also shows the previous peak being around 26. 26-to-1. We're actually getting pretty close to there, which it kind of ties into us being close to that upper blue trend line on the monthly chart. And if we stay at 26 and DXY's in the low 90s, it also is roughly 2300. It actually is a little bit higher. It's 23 and change. So all these are kind of pointing to a target, a final target on gold for this specific bull above 2200. Some of them are even more significantly. If you did a 94 times 26, DXY 94 times 26, that's 2444. So you're kind of in that 22 to 23, 2400 range for a lot of these. I don't think we're going to get all the way to 2400. I don't know if we have enough time left, but at least on the short term, before DXY, if it does in fact bottom. Now, if DXY implodes, this ratio could blow out to 30, and that's a completely different scenario, obviously. The MACD here, though, does show that it still has plenty of room. And last time we were all the way up at 2, and now we're only at a 130 on the MACD. So we still have room to run. But it's interesting to see how smooth of an arc this is, and how much bullish pressure. As I don't even remember in 2011 if I was going on watching CNBC or Bloomberg and having every fund manager pumping gold. I mean, I never thought in a million years that every macro fund would be bullish gold, and be it would be almost acceptable and then you wouldn't be a crackpot investing in gold. But now it's actually a hot thing, which is actually kind of concerning from a bull standpoint. Maybe the trade is going to get here a little bit too crowded. But for now, the trend is still intact. And this previous peak shows we still have a little bit of room to run, at least in the short term. Okay. And then last time, we kind of did a gold Bitcoin comparison. Well, I also want to start doing a Treasury to gold comparison as a market cap comparison. And for many that may not be aware, total physical treasuries as of earlier this year, obviously now it's changing by the minute, but as of middle of this year, I think roughly it was May, there's roughly 18 trillion outstanding in actual US Treasury bonds. And when we first started this, gold was at 7.07 trillion as of May of last year, 2019. And in that short period alone, we've gone from 707 up to 1285 or 12.85 trillion on gold for a total market cap, global market cap or market valuation. So even in this 1 year alone, the Treasury gold market cap multiple dropped from 2.6 all the way down to 1.4. And for those that are curious, well, what would happen to the price of gold in order to equal the value of U.S. Treasuries, assuming they don't print more? It would actually be 29.37. So you're starting to see, once you start using a lot of these kind of metrics or ratios, you can kind of get a feel for gold does still have a lot to the upside from in the long-term standpoint. I don't think we're anywhere near the ultimate top in gold. I'm talking, 10, 15, 20 years out. But in the short term, technical trend lines are different. Obviously they have a factor, but
I never would have guessed it was that close.
yeah. And I didn't, and to be honest, I was curious, and I knew there was obviously our total national debt's 25 trillion, but not all of it's held in actual physical treasury bonds. Obviously, you have other instruments. So
I was talking about gold being as close to the total number of bonds out there.
Correct. I mean, and it
because
wasn't.
everyone talks about it being such a, it doesn't take much money to move it. It's, the market cap, maybe they're talking about miners, all right? Like the market cap of miners.
That's different. I mean, that's obviously a much larger number. But as far as, this is just physical bullion. I mean, gold bars.
Right.
So, and obviously, Treasury is mostly held by institutional sovereign wealth funds, central banks, and of course, gold is pretty much almost, staggering majority, almost 90% is in central banks somewhere.
Can you think of any scenario, Mystery, where central banks might liquidate gold?
So here's the thing, and I know Peter Schiff's been pounding the table for like 20 years, but I have to give him credit. He finally was right on a lot of things, and he did make one good point that I like, that I always kind of thought of, is that there's no such thing as too little gold. You simply have to allow gold to naturally appreciate to its true fair market value in order to then balance out the global debt. The reason there's so much global debt is because gold is actually not allowed to appreciate to its normal value. If gold were appreciate to what many have argued is the quote unquote true value in order to balance out the global debt, it'd be above 50,000 an ounce. And at that point, there would actually be no debt. But I don't see it going there, so please don't quote me on that. I'm just making a point that that's where you could see a scenario where central banks could liquefy. I mean, if we get some sort of crazy move to the upside, maybe 5, 10,000, 15,000 an ounce. I know it sounds crazy now, but I mean, ironically enough, I think Bitcoin kind of turned the light bulb on when people are saying, wait a minute, if Bitcoin can get there, well, why can't gold? So I think you're starting to see a lot of this kind of creep into the gold market. But it's interesting that, 1.4 times, that's not that far. I mean, there's, we talk about global Forex parity. Well, we could have, Treasury gold parity here pretty soon. So that's a whole nother, and Treasury bonds are obviously the number one store of liquidity globally. So it's kind of, when you think about it, if gold were to even surpass that, that's really, you're kind of getting into unknown territory, because not even in on a relative basis in 2011 or even in the 1970s was this the case. So kind of interesting times, sign of the times that we're, where gold is really starting to make a case here for itself.
Okay.
And then also I want to go over gold, Bitcoin.
There you go, Jane.
Yeah. So I know everyone always loves this. They always quote this one. So this again is, I've kind of touched on this the last few presentations, because people like it. It's good to kind of monitor and see where gold is relative to Bitcoin, and to kind of give a frame of reference. A lot of people use a lot of hyperbole and a lot of hype and buzz, but when you actually look at the actual numbers, so just from last meeting in May, which is May 26th, Bitcoin actually had a decent move. It had a move to the upside, which I'll cover here, and it actually broke out from my key macro trend line. And I said if it did that, then there was chance to at least potentially revisit the all-time highs again at some point. So it did break out, and on a percentage basis, it did break out even more than gold. But let's temper our enthusiasm a little bit, because that big jump in price or on a percentage basis really only netted in a increase in 57 billion in total market cap. So it went from about 161 up to 218 billion. So many will say, oh, well, the ratio went down from 66 all the way to 58, you know, from stratospheric to just nosebleed. But I mean, when you look at the actual nominal dollar value of market cap appreciation, I mean, gold went from 10.6 trillion to 12.8 trillion. So I mean, it's like an early Mike Tyson fight. It's not even close. It's a knockout, first round knockout. So it's kind of important to see when you take a step back and take a look at it and see, okay, well, how?
Well, trillion's a new billion, because billion doesn't mean as much anymore. So
It really is. Yeah, it's kind of
a billion's like,
oh, it's like a million.
it's passe. Everything has to be done in trillions now, partner.
I know. So anyways, it's just kind of cool to see the comparison and just get but it's still 58 times, which is obviously a massive amount. Now, I know some people are saying Bitcoin's going to go to a million or whatever crazy number, but I don't know. I'm still skeptical. Maybe I'm wrong. You can call me out on it. That's fine. But to me, I still believe that the central banks have every incentive to use gold as a weapon against Bitcoin and not the other way around. And on a nominal basis, the price it would have to get to even remotely resemble gold, it's pretty obscene. Can it? Maybe
50,000
over, yeah, easily. Well, no, you're talking hundreds of thousands.
Okay, all right.
So it's kind of, it's getting into tinfoil hat territory.
Okay.
So this was actually the Bitcoin chart I brought up last time. We had this long-term purple descending trend line, resistance trend line, going back all the way to the peak from late 2017. And for a while there, it was looking like maybe it was actually going to hold, but then I think gold kind of racing out the gate kind of helped pull Bitcoin with it. So we got a big breakout. As of right now, it's still respecting the upper Bollinger. It's not really blasting higher, so perhaps they may be a consolidation. It's also important to note that this kind of 12,000 level was also 1, 2, 3, 4, about 5 on a closing basis, held 5 different times before. So this is actually a major kind of horizontal resistance as well too, which I don't have drawn, but you can clearly see it's right there. So we'll see. I mean, at least it broke out of the purple trend line, so bulls can be happy about that. Whether or not we need to consolidate back to the 13, that'll kind of reveal a little bit more. But for now, it's actually doing pretty good. So this kind of all ties in. Gold is kind of continuing to reassert itself into the global monetary order. In the process, gold will be a key player in a post-singular currency world. And the ultimate goal is having a bipolar wealth world. With we have STRs and, like I discussed last time, and gold. And then how does all this tie in together? Well, we brought up I brought this chart up last time, which is actually my favorite chart. And this, I hypothesized last time that the gold had officially broken the DXY inverse relationship that it held for the longest time. And we said that in theory, this chart should not make any sense. If, dollar was a constant, how can it go from an previous all-time high of 1920 when the DXY was at 72 all the way down to 1050 when the DXY hit 100 previously in 15 and 16, and then that drop from 100 down to 89 popped gold from 1050 all the way up to a stratospheric 1360, and for a long time that held as the interim term high. Well, what happened? Well, DXY went up from 89 to 101, but gold went up, which makes absolutely no sense. And this kind of starting to tie into what the analogy I used last time of the Milky Way galaxy. Because this is against a basket of currencies, gold is now appreciating across all currencies, and that's what you're seeing here. So people say, oh, well, if you think dollars DXY is going to go to 109, does that mean gold is going to crash? Well, up until May of this year, no. I would have said yes, that probably would happen. But now that it's completely broken the relationship, we can't really use that anymore, because clearly, going from 89 to 101, you add roughly almost $400 to gold price, and then going from 101 back down to 93. When this previous time, when it went from 100 down to 89, it was only a 200 point move, roughly. Sorry, roughly 300 point move. Sorry.
Okay.
Whereas this one, the same 100 down to a much higher level was almost a 400 point move or a $370 move. So you're starting to see how even if we go, much higher up to, I think the ultimate target on this is 109, that doesn't necessarily mean gold has to crash to an obscene number. And for the longest time, I thought it would, because this relationship had held. I mean, remember when we spoke back in last May, I thought because it was holding at the time that gold would drop below 1,000. But once it broke down from 1360, I backed off that, and I realized that this wasn't correct anymore, because it wasn't lining up. As the dollar was rising, gold wasn't being impacted anymore. And I think a lot of that is, the U.S. Treasury demand that we've been talking about. Is you're seeing so much money piling in from other aspects that I think the U.S. Treasury gold relationship is actually more important than the inverse DXY relationship, because now it's clearly being broken. But if you look clearly, the MACD and stochastics patterns are almost identical to this consolidation period. It dropped below the center line. Even the kind of descending orange bear channel is forming, and we are approaching, if you see right here, a very extreme low, very similar to October of 14, which is when the dollar bottomed last time, the big dollar bottom.
Nice presentation, Mystery.
Thank you, I appreciate it. And so it's kind of the reason I keep bringing this up is, there's an old saying, correlations work until they don't. And I know for the longest time, people get kind of marred, almost dogmatic, and being so extreme as, oh, well, if this does, A does this, then B must do that. And it's sometimes as traders, we need to kind of back off those absolutes, because a lot of times there's external factors that can skew the market one way or the other that will no longer make that relationship work in a predictable pattern or a predictable habit. So that's ultimately what this chart is showing, is that yes, I do believe DXY is going up, but that does not necessarily mean gold is going to crash $1,000 or 1,000 points. It's
the next relationship that'll probably be part of your next visit here will be to see if the correlation of higher yields, because I think it'll happen by the time we talk.
Sure.
I'm not saying permanently up, but
Yeah.
some type of squeeze in yields.
Sure.
And then back down, to see if that traditional correlation works, which should mean should put pressure on prices, because gold really rallied because we had negative real yields.
Correct.
So if yields
No,
start to head
that'll
up,
be
we'll see.
that'll be my homework assignment for next time.
Yeah. So I think yields will become part of the discussion with the dollar and everything, Alex. Be interesting to see if we break away.
I definitely believe that. My only concern about having any sort of significant yield pop is that during the 08-09 recession, they kept them artificially low for a long period of time. And so right now, I even tell my Charge Coast members, like, you can't, first of all, bonds are almost impossible to trade right now. The premiums are absurd, and it's really hard to make money doing it right now, which is not like 2019 where it was the most profitable asset class to
TLT
trade.
used to be very liquid.
Oh my God, it was, not only that, but you could go $3 out the money for pennies and just have monster trades. Now you got to go $8 to $10 out the money for the same contract price. So the market makers, they gutted that market, which it was overcrowded and needed to be done.
The Fed did.
That too, but that's why I although everyone's saying pop yields, I've been telling over on my platform, do not try and short it yet. It's not a viable trade yet. Just you can use it as a macroeconomic indicator, but right now you just can't touch it, because basically the Fed's jumping in, and it's now an artificially suppressed market. So
it is.
Artificially keeping it up or depressing yields.
And you're not, you know what? You're not artificial. You're authentic. And you give us your real ideas and thoughtful insights about the big picture. Really appreciated, Alex. And
of course,
and
then I wanted to touch base.
Go ahead.
So the reason why I wanted to bring this up is if you look at every key bottom, Um, I looked back at every major dollar bottom along this bull channel, and I counted how many weeks did it take before from initial touch to quote unquote ideal entry before some sort of major breakout happened, which would be inverse on the euro or a peak on a euro.
Right. Right.
Um, and I found something interesting. So the two extremes were 9 weeks and 17 weeks. And if we assume a normalized distribution or bell curve, that would put the mean or median at around roughly 12 to 13 weeks. Well, the two middle examples of the four, sample size 4, was also 12 and 13 weeks. So if we assume that using that as a kind of I know it's only 4 sample set, but assuming we use that as a sample set, I believe that sometime within the 9 to 13 weeks, we will have some sort of a geopolitical or some kind of shock to the system that's going to make the DXY pop off the bottom trend line. The reason why I cut out 17 is because 17 happened all the way back in the early 2000s, and sorry, yeah, the aughts, or whatever you want to call them, and that. And ever since then, it's actually been a decreasing pattern. So it was 17, then 12, and 13, and then 9. So it's been in a decreasing pattern. So to me, I'm more on the left tail side of this curve. That would put us between 9 and 13 weeks. Well, if you do 9 to 13 weeks from the initial touch at the end of July, that puts us roughly between October 2nd and October 30th. So if it's October 2nd, October 30th, something big is going to happen, enough to cause some sort of major shock, assuming this trend line holds and assuming I'm not completely wrong and assuming none of this is just purely theoretical. What could possibly cause that to happen? And so then I thought, okay, well, what are possible catalysts? And maybe Biden starts leading seriously in the polls. Maybe there will be an administration change and that'll cause some sort of shock to equity markets and cause them to weaken. Maybe there's another possible virus wave. Maybe things get a lot worse. Could it be like number 4, number 5, like some sort of Italy exit or Grexit or
I know a guy looking for number 4.
number 4, and
Yeah.
I don't think
Italy.
it's exclusively number 5 because the pound is only 13.1% of the DXY. It's not enough to cause that kind of an outsized move. So maybe 4 and 5 is a package deal. They may not be mutually exclusive.
Okay.
Maybe Brexit, some sort of escalation causes more sovereign debt fears, and Italy and Greece kind of come into it. Or there's always, the potential unknown black swan. We never saw COVID coming, and that happened. So these are kind of the possible catalysts that I see potentially causing that shock. And then, essentially, like as a conclusion, global Forex parity will potentially, it's potentially entering its final phase. Initially from part 1, the parity window was between April 2019 and March 2025. The median or mean of that is March 2022. This time, the consolidation period, I believe, is now accelerated. It's not going to stall out to March. We're actually in it now. And so if that 9 to 13 week clock countdown starts, it's going to be somewhere between October 2nd and October 30th, which actually was the biggest problem I had with part 3. I couldn't reconcile why it would stall to March if I believe there's going to be some sort of a downturn in the economy before the election. Again, that's just a hypothesis. Things may rally into the election, but if the global elite really want to get Trump out, they're going to have to. Something ugly is going to happen. Some bombshell, whether it be a scandal or whatever it may be. I don't know. This would be your window, October 2nd to October 30th, where you would start to see that happen. And then obviously gold is still cheap on a historical basis, and ultimately we'd be in a 2-tiered system. So that's kind of the gist of what I wanted to present today. And I don't know if you had any questions as far as your users, or if they had any comments.
No, go ahead, do your commercial.
Okay. This is obviously my charts coach. Over the last month, I've added like 30 different new features. I mean, it's turned into a really robust platform. It's funny, I started the platform to be for like educational and beginners, but to be honest, 60 to 70% of my members are actually fund managers, believe it or not. So it's mostly professionals on the platform, which is kind of cool. And then I have exciting news that I'm actually going to be doing a private podcast on the platform, a weekly kind of update between our chats, because everybody loves our chats so much, but everyone's always like, well, can you do more in between them? So I kind of decided to fill the gap based on a lot of requests. So I'll do, if you ever want to, hear from me in between our great interviews, that's always a possibility. And so that'll be coming up hopefully here in the next
What's
month.
The website address?
Yeah, here you go. So it's chartscoach.com, and on Twitter, it's at MysteryTrader99. If you'll have any questions, feel free to reach out. But I really wanted to thank you, Dale, for always being gracious and inviting me on and kind of sharing my thesis. And we'll find out. Maybe in the next 30 days, I'm completely wrong. I'll be the first to admit it. But, if it starts to hold here, we need to take a lot of this data into context and see, use it to benefit.
I had a manager when I was a commodity broker who said, you can't drive a taxi cab without getting tickets. So you can't be an analyst without being wrong.
Of course, and I fully acknowledge that.
So, that's part of it.
Yeah, the goal is to be at least 80%. You do that, you're doing pretty good.
Yeah, and thank you so much for your presentation today, Alex. I hope you and your family remain untouched from COVID. Any final thoughts on COVID?
Right now we're kind of in I don't know if it's a cognitive dissonance or kind of a lull. I mean, things are still ugly in many parts of the country, but it's not having it's causing two different economies. There's the financial market economy, which is screaming to all-time highs, and the Main Street economy where everyone's angry and frustrated, like, what's going on? Life sucks, and yet I'm seeing the stock market rally every day. That causes a lot of dystopian kind of people are upset, and that's why you're seeing these riots. You're seeing it's just a lot of general frustration, and I think it's unfortunate, but that's what happens when ironically enough, Federal Reserve liquidity injections actually causes more economic disparity and a much bigger gap between the different classes than had they just allowed the system to kind of correct. But they have their political motives and whatnot. So I hope to God there's not a second wave. But if 1918 is an example, and also I'm here in Texas and we're a hot spot, and it's I have my family members fighting on the front line, so I get private data that nobody else sees. And it's hovering between 19.5% to 22% constantly testing positive. Wow. So it's still a thing.
It's a mess.
I hope, hopefully we get through it, and I hope people take it seriously. But if not, there'll probably be a resurgence in the fall, unfortunately. So.
Okay, buddy. All right. Well,
just stay safe, Dale. Thank you so much. And
all right,
hope
bro.
the whole team stays safe and have a good one.
All right, and we'll schedule something for like November. How's that?
Perfect.
Right around when the cycles are completing.
That sounds perfect. I'm looking forward to it. Thanks, Dale. Appreciate it.
You're welcome. All right, everyone. That's a wrap for Turnaround Tuesday. Remember, don't just count your pips, count your blessings. You could find Alex at MysteryTrader99 or Trading Coach, and that's a wrap. Good hunting the rest of the day, everyone.